Question here from Fifth says, you listened to Tom Tobin the other day on healthcare. I was curious about both of your thoughts on the space. Seems to him like there's a bubble waiting to burst there.
Yeah, I mean, look at healthcare. You can look at it a lot of different ways. Obviously, you can look at it bottom up. You can look at it top down. I look at it top down. Tom looks at it top down from a sector perspective, but bottom up from a company perspective, and Neil looks at it probably everywhere in between. But if you look at healthcare, it's underperformed this year. I think it's up 3%. It's had a bad month to start the month. It's down, I believe, for the month. It's got a lot of things that people already own. And I think people know that. There's also political risk people are concerned about that I'm not concerned about from a top-down perspective. This isn't Tom's sector view. It's just it's a macro risk view that people have allocated to healthcare, which is that Hillary would be a negative for healthcare pricing. And we've written about this. Emily Evans has written about this on the policy side, healthcare policy side for us, saying, hey, don't forget how big cap pharma is as a lobby, and they pretty much have bought the Clintons in the past, and they're pretty much bought and paid for this time. So in other words, Hillary will talk big game and talk that she'll make pricing better for everyone, but then once she gets elected, she won't do that. So that the macro view is kind of this sideways action in a sector that's underperforming. I think that's kind of how we've talked about it. And then from Tom's perspective, it's like, no, we're at the peak. We're at the peak in utilization. We're at the peak in a lot of margins. We're at the peak in a lot of things that would be classically late cycle, which we wouldn't disagree with economically either. So that's kind of it's why healthcare has been a tough one for people this year, partly because everybody had already owned it coming into this year, but partly because of a lot of different things that matter to healthcare, which it's a long list.
My take on healthcare is that particularly as you look into next year and as the new administration goes in there, you're going to see a continuation of a trend that's already underway, and that is increasing volume and just squeezed profit margins. And I just see that as a political necessity, a kind of a necessity of our political economy right now. Healthcare has been on a juggernaut for the last 40 years in terms of its share of GDP, and it's become unaffordable. Unless we radically change how we fund it, and this is the other part. I separate healthcare, first of all, into two different pieces. One is the providers and how much business they're going to have. They can have a lot of business, no question about that. Anyone who goes into healthcare is going to get a job. The question is, are they going to get earnings? Okay, that's the question. And then the second part is insurance. Yeah. The insurance model is troubled now because of people pulling out of Obamacare, and that has real problems. It's all going to very low margin things for insurance. The one high margin thing they have, the one great thing in the insurance industry is Medicare Advantage. You got this enormous Amazon river of new 65-year-olds. Yeah. And that's the one place where they can make money. But that's kind of it. I think if that party is stopped, so I think in the working age population, where historically the insurance industry makes most of its money, that's kind of a dying area. As we've pointed out many times, the population in midlife is actually declining. I'm talking about in absolute numbers over the past 10, 15 years. People age, 50 to age 65. These are the Gen Xers. These are baby busters. This is the high margin group. This is the oldest you can get before Medicare, and that's where the health insurance company makes most of their money. They're spending the most on healthcare before they reach age 65, and that's actually a declining number. We've talked about that before. This is tough. Anyway, healthcare, lots of business. The question is, can they make any money at it?
Absolutely. Here's I don't know if Josephine has this, Darius, or not, but on the earnings quarter to date, where we have 463 companies have reported, I'm just going to highlight a point that Neil just made. There's the rate of change point, and then there's the absolute point. I mean, Neil's saying, hey, look, are you going to have any earnings at all? Well, the question that goes pari passu with that is basically what is the growth rate, or the growth rate relative to expectations of healthcare earnings growth. So do we have that slide up that we show all the earnings by sector, Darius, right now?
Yeah, we do.
Yeah, we have.
So you can see, like healthcare, to Neil's point, with ACA, they've had a lot of revenue, but to look at the earnings growth rate is half of what the revenue is right now. And more importantly, like if we showed this, I think it's on slide 14 where we show all the sectors historically, sales and earnings growth. I think it's slide 14 in the current macro deck. You could see that healthcare sales and earnings growth were much stronger than what they were, well, what they are now. And that's typically what happens. Forget what's happened to the stock market with everybody saying, well, if it's got a yield, I got to buy it. You know, you go do whatever you want to do. That's fine. We want to own the ones with the higher yields because they go up higher. But net, you know, typically what happens to sectors and companies is that when their sales slow from 20% to 15% to healthcare's 9%, and earnings go from 20% growth or 15% growth to 5%, you know, the sector loses its multiple, and that's typically, you know, kind of go-to macro playbook in terms of both, and that's really what Tom Tobin's concerned about, Darius. I think if you were to you go through with him, he calls it the ACA taper, and that's like, okay, the volumes are going to be big, but they're going to be, you know, less big in rate of change terms, and earnings growth is going to